When it comes to international relations, the U.S. has established great alliances worldwide. Even though the alliances are rooted in common values, interests, and decades of cooperation, some nations have stood by the U.S. thick and thin, providing support and cooperation. Nevertheless, following the victory of Donald Trump as president, newly published statistics on foreign holdings of U.S. Treasury securities indicate a major retreat. Why are these pullbacks happening? And who are the primary holders that collectively are causing these pullbacks? Come with us as we reveal why U.S. allies, Japan, UK, Saudi Arabia, Switzerland, India, South Korea, and Germany are parting ways with U.S. treasuries. Just days following Donald Trump's November 2024 presidential win, new data on foreign ownership of U.S. Treasury securities show a distinct trend: a global retreat by leading foreign investors. 16 of the 20 economies tracked have lowered their holdings, which indicates a change in global market sentiment. Imposing fresh 25% bilateral tariffs, especially against prominent sectors like cars, computer chips, and pharmaceuticals, would potentially still expedite the U.S. Treasury sale even faster. In response, most countries are eliminating their exposure to the United States debt in a larger bid to avoid U.S. dependence. These nations resist trade barriers by selling treasuries, reallocating reserves to other assets such as gold and other currencies, and enhancing economic links with China, the EU, or regional trade blocs. The biggest declines in U.S. Treasury holdings came from the UK, which declined by $44.1 billion, followed by Japan, with a decline of $27.3 billion, and Saudi Arabia, with a decline of $15.1 billion. China, Switzerland, and India reduced their holdings significantly by $9.6 billion, $9.7 billion, and $14.9 billion, respectively. While these efforts are partially motivated by more general schemes for financial diversification, they also respond to growing geopolitical and economic uncertainties because of changing U.S. policy. In addition, this massive sell-off indicates that foreign investors and central banks still worry about the possible risks of a second Trump term. Institutional investors and foreign governments traditionally carefully track U.S. policy indicators, especially in trade, money policy, and diplomacy. Countries will decrease their holdings of American assets to hedge against possible financial chaos if they view these indicators as risky or aggressive. Apart from geopolitics, there is also concern over U.S. government debt. Primary creditors would discount U.S. treasuries if they expected a policy to debase the currency or expand the federal deficit. Amid a foreign sell-off on a large scale, it increases U.S. debt yields, making federal government, corporate, and individual borrowing more expensive. However, how are investors rebalancing their portfolios to reflect de-dollarization and diversification in reshaping the financial world in the next few years? For much of the dollar's recent history, it has been regarded as the dominant currency in the world. However, declining foreign ownership of U.S. assets signifies a brand shift toward euros, other currencies, or precious metals such as gold. It's a gradual decline from steady holdings in Treasury securities by China, which had $760.1 billion by October 2024, a low not seen since February 2009. Such a downshifting trend reflects global concerns about over-relying on the dollar and acknowledging the dangers of U.S. economic safeguards. The geopolitical leverage offered to the U.S. through the dollar's supremacy in international commerce has often been used to impose economic sanctions and sway global financial markets. This very power, however, has prompted countries to rethink their reliance on dollar-based assets to safeguard themselves from future economic coercion. Some governments see diversification into other currencies as a strategic necessity rather than a financial decision. They aim to dilute their vulnerability to U.S. monetary policies and trade restrictions. The shift is becoming clear with interventions employed by sovereign wealth funds and central banks, which has been discussed in an episode from Unhedged. In recent years, countries such as Poland, Turkey, India, Iran, and China have heavily built up their gold reserves, viewing gold as a great protector against future U.S. sanctions. A push toward gold and other alternative assets would appear to be an attempt to shield economies from fluctuations in financial health and geopolitical. Changing reserve management policy. As the largest economy in the Eurozone, Germany used to hold U.S. treasuries as foreign exchange reserves, which the Bundesbank managed. Reserve allocation has been affected by recent monetary policy changes by the European Central Bank, ECB, and inflation issues. In addition, Germany has also been investing increasingly in green bonds and sustainable financial instruments alongside its long-term economic sustainability goals. Another key motivation might be Germany's attempt to consolidate the euro as a reserve currency, making it a competitive replacement for the US dollar. As intragroup trade and financial relations between the EU and other international partners deepen, Germany may be actively reshuffling its holdings towards the higher strategic objective of reducing dollar-denominated asset dependence. Norway's Government Pension Fund, Global GPFG, the second-largest sovereign wealth fund in the world, reduced U.S. Treasury holdings to $57 billion from $66 billion between August and December 2024. This realignment of assets to those of higher return is especially due to shifts in global interest rates. Norway's wealthy oil revenues invest prudently to ensure stability in the long run and the highest returns. The decrease in Treasury holdings reflects a more general diversification strategy, potentially driven by heightened geopolitical risks and volatile market conditions. Norway's financial policies avoid single asset classes while maintaining robust and diversified foreign reserves. Overall, while some of these moves reflect broader financial diversification efforts, they also underscore rising geopolitical and economic uncertainties in the wake of shifting U.S. policies. Anyway, do you think the U.S. dollar remains the world reserve currency? And how are nations increasingly seeking alternative financial systems to hedge risks of excessive exposure to U.S. assets? Share your thoughts with us in the comments section. Remember to like, share, and subscribe for more. Also, click the next video showing on your screen. You will enjoy it.